Welcome back, everybody. It's good to have you to another real estate market update for the greater Milwaukee area, this time February 2022. So what's going on in the market? As you know, it remains to be incredibly hot. Actually, it seems to be getting even more competitive, if that is even possible, after what we have seen last year. And the reason for that is easy to understand. On the one hand, we have a huge demand on the buyer side. We have, amongst other things, in the Milwaukee area alone, about 300,000 millennials that are contemplating now about buying their first home. They're aging in their prime home buying years. There's also other groups that are buying. So we continue to have incredibly high demand. And we're doing this in a market that is selling about 10,000 single family homes in a year. So easy to understand how that is creating a very hot market. But we are introducing now a couple of other elements that are pulling the market in different directions. So this is why I think it's debatable which direction that is going to go. We have inflation. I'm going to show you the latest numbers here today and what this is going to the real estate market. And also the Fed is, of course, reacting to what's going on with inflation. So we're seeing interest rates going up, and we also have a new dynamic with inventory. So those are the things that I want to talk about today, so we have a little bit of an idea in which direction this train is taking us. So let's get started and look at some numbers from January. January has been a very difficult, a very challenging market to navigate, very frustrating for a lot of people because of the low inventory. This is, of course, not unexpected. If you've been following my videos, you know this. Buyers and sellers are typically not on the same page here in Milwaukee in the first couple months of the year. The reason is simple. Buyers are out there right after the holidays. They're looking for inventory. It's just not there. And sellers that want to bring the house on the market, they still need a little bit more time. They need a couple months to get the house ready, get it painted, get it staged, and get it on the market. So we're seeing that disconnect every year. And of course, that creates a very competitive situation. The inventory that you're seeing in the market is leftover stuff from last year that didn't sell for one reason or another. And the few really nice listings that are coming on the market are getting way too much attention. And you create these very heated bidding wars, these very competitive situation. So that can be very frustrating. We've written quite a number of offers, my team and I, in January that did not go through. We managed finally to get 9 properties on the contract. So congratulations to our buyers and our sellers. If you're not on the contract by now, I think things are getting better. You see this already on the MLS. Every week we are seeing more and more listings coming on the market. So things are improving as we're speaking. Now let's take a look at the numbers. So inventory has been very low, kind of in line with what we've seen last year. Prices are up already, and you have, as always, the benchmark here from 2015 January. You can see we had almost 11,000 units in inventory back then, and now we're here around 2,400. Prices, on the other hand, 142,000 compared to 240,000, so about 100,000 more, and already up 6.1% just for January. So inventory has been very low. This is a seasonal pattern that we have every year, but I think this year it was more pronounced because of Omicron. So listing numbers in November and December have been, even extremely lower than we usually see them. And the one positive that we're seeing here is we have an increase in inventory here in the Milwaukee area, Milwaukee County that is, but when you look in the details, you see that there is a lot of listings below $100,000 that are hitting the market. So that is the biggest chunk of that increase that we're seeing here. So this is basically the real estate market as we know, the dynamic that we have gotten used to. We have not enough supply, we have too much demand, competitive bidding situation keeps driving up prices, right? So we would keep going down that alley if it wouldn't be for a change in dynamic, for a new element, and that is, of course, inflation. That can have a huge impact on what's going to happen in the market going forward. So we've just got the latest numbers. Consumer price index in January went up 7.5%. That is up over December again. And we have to go back actually more than 40 years to find numbers like this. We have to go back to the 1980s to see that last inflation spike here. So looking at this, I'm not convinced that we already have peaked out on inflation, but we will see what's going to happen over the next few months. Now, this is going to have a number of effects on the real estate market, and they're pulling or pushing the market in opposite directions. So it's a little debatable on what this is actually going to do net bottom line, because on the one hand, it should have a calming effect on the real estate market. If prices are going up for goods and services, for groceries, for gas, for used cars, that means there is less money on the table for consumers to actually spend on housing. So that should calm down the market. On the other hand, it also creates an incentive for people to get into real estate, and we're talking about that in a second, and that will create a dynamic that's heating up the market even more. And then on top of that, of course, you have the Fed that needs to do something, because 7.5% inflation is not healthy for the US economy. It's not healthy for the US dollar, where the dollar is devaluating too fast. That means the value of savings, the value of retirement accounts is coming down. It's also not healthy for the economy, so they really have to bring this down. And the problem is inflation has a self-fulfilling prophecy dynamic, because businesses are raising prices because they're anticipating that their cost is going up, that their wages are going up. So they're trying to get ahead of this with price increases, which of course creates even more inflation. So the Fed has to psychologically, if you will, calm down the market, reassure everybody it's going to be okay, and then also take steps to do that. And one of the ways they're doing this is they're actually going to start hiking interest rates. And that also has an effect on the real estate market, and we'll talk about that here in just a minute. Now, I want to just quickly take a segue here on rents, because when you look at the history, you can see that rents are traditionally going up even faster than inflation. You can see that here. The blue line is the core inflation rate, and the orange line is rental price appreciation. So when you own a house and you have a 30-year fixed rate mortgage, your monthly payment is locked in. If it's going to be $2,000, you are going to be paying $2,000 next year and the year after, no matter what inflation is doing. If you're renting, you have no control over what your rent payment is going to be. So you're exposed to inflation as a financial risk. So that creates an incentive for people to get into the housing market. We spoke about the 300,000 millennials that we have in the greater Milwaukee area. Many of them are looking at this, and that's the reason why they're pushing into the market. Now, on the other hand, home ownership is also a hedge against inflation. And here I have some data going back to the 1970s. And what you can see here is in blue, the inflation rate, and in orange, the home price appreciation. Remember when we looked at the two spikes on the inflation chart, it was really high in the 70s and 80s. Those are basically the averages, and you can see what home prices have done in that period. And then it calmed down here a little bit for the last 3 decades, or for the following 3 decades, but you can still see that home price appreciation stays above inflation. And then this dynamic has really picked up. And in the last year, you can see inflation 6.8% and 18% home price appreciation. So that shows that owning a home is a hard asset. It tends to hold its value or even go up in value, and it's a better bet than a lot of the paper assets. Now let's take a look at rates. So the Fed is going to increase rates, but these rates are not actually directly affecting mortgage rates. A lot of people think that is the same thing. You can see here that rates already have gone up a lot faster than anticipated. You have seen the numbers that I had in the last few months that were predicting basically 3.7, 3.8% by the end of the year. We are basically there already, and it's just mid-February. So rates are going up, and I would not be surprised if we see 4.5, maybe even 5% coming up here very soon in the near future. And what this is doing is experts have been, maybe you've seen it in the news, they have predicted, okay, if rates are going up, that's going to slow down the real estate market because it creates issues with affordability. I doubt that it will really slow down the real estate market that much, because people are seeing this, and they have when I talk to my clients, many of them expressed it. They said, yeah, we really want to lock something in. We really want to get into a property, or we really want to sell our house now and get into that bigger property and lock in a larger mortgage before rates are going up too high. So that is that dynamic that we're seeing here. I think before we start slowing down the market, we really have to see rates over 5 or 6%. And if that sounds crazy to you, let's take a look what rates have done in the past. And you can see, we've gotten so used to these ultra low mortgage rates. People are complaining if rates go from 3% to 3.5%. Oh my God, so expensive. But you have to look back at what has been normal historically. I remember when I got my first mortgage and it was for 5.5%, I was actually really happy that I was below 6%. And now we are currently at about 3.7%. So we'll see where that is going. If you want to understand what is really driving mortgage rates, then follow the 10-year Treasury yield. because there is it's not the same, but there is a very close correlation. You can see this very clearly from this chart here. Mortgage rates actually peaked out here in the 80s at 18.53% if you're interested in. And now we're down here, but the 10-year Treasury yield is going up, and we're going to see mortgage rates follow that as well. So we'll see where this is taking us, but I think the prediction to be in the high threes by the end of the year is too low. I would not be surprised if we see 4.5% fairly soon, and maybe even 5% by the end of the year. Now let's take a look at inventory. I have here a chart that shows foreclosures. A lot of people are asking me, when is the wave of foreclosures coming? When is the market crashing? I'm not showing you the charts behind this. We are monitoring forbearance. We're looking at all that on a monthly basis. But this is basically the outcome. This is what's happening with foreclosures. In the height of the market, we've almost seen 3 million foreclosures a month, and now we're down to 151,000, and that's for the entire US. So everything in red here is over 1 million, and now this is, just 150,000. That's over the entire country and for the year of 2021. So are we going to see an increase in foreclosures? I think yes, that number is going to come up, because we have still about a million homes in the forbearance program, and some of them will not make it. The vast majority will make it successfully, but some of them will not, maybe 15-20% of them, and they will show up in foreclosures. So when you see in the news that foreclosures have doubled, I want you to think at this chart, because going from 150,000 to 300,000 means that the number of foreclosures have doubled. And that sounds really alarming, but really memorize this chart, because 300,000 is not a big deal. In fact, we would actually really be happy in the real estate market if we would have that additional inventory coming in. It would be really helpful. So it looks like foreclosures are not going to bring relief to the tight inventory that we have on the market. What about new construction? I have here fresh numbers from the Wisconsin Builders Association, and it shows that in 2021 we have built actually fewer homes than in the year before, which is completely counterintuitive. You would expect a building boom, and it's not happening. 4.7% fewer houses in Wisconsin. How does this break down by county? You can see here Milwaukee County is not even a player, just 158 new construction permits. Ozaukee County a little over 200 and shrinking. Waukesha County is trying to save us with almost 1,000. And Washington is a smaller player, and they also have a little bit of an increase. But overall, we have two problems when it comes to inventory and new construction. It's, first of all, it's not enough. It's only about, 1,700 here when you total up these numbers in the 4 counties in the greater Milwaukee area. So it's not enough to make an impact in the inventory situation that we have. And the second problem is way too expensive. So new construction is usually around $600,000, $800,000. That does not really relieve the inventory pressure for the average median, home buyer in the Milwaukee area. It's just too expensive. And the reason why builders are not putting out more inventory is because they're facing the same issues that everybody else with inflation. It's just construction material costs have been going up, and it's difficult to get contractors. And with the cost being so high, it's also an affordability issue. So that increases the pressure on the existing home market. And we don't have to expect a whole lot in 2022 from the new construction market here, unfortunately. What we would need, and hopefully our politicians are going to change the direction here and going to do something. We would need a building boom, as Milwaukee has seen, for example, in the 1960s, where these large subdivisions have to develop and houses have been built by the thousands, and in the median price range, so they're affordable for the average people. We're not seeing this. We're only seeing small numbers of luxury homes, and that does not really help with the inventory problem. So bottom line is, new construction is not going to have a major impact on inventory here anytime soon. What can we expect for pricing? So I have some data here. This is a panel of 100 national real estate experts from big banks, from major institutions. And they're asked what they're expecting for the real estate market for the next 5 years. And you can see here, I've divided it up in 3 groups. We have here the optimists. They are thinking in the next 5 years, home values will go up 62% by 2026. The pessimists are thinking 23.7%, and the average of all of them is 43.3%. Now, it's incredibly difficult to forecast what's going to happen in 5 years. Nobody can do that. It's difficult enough to anticipate what might happen in the Milwaukee market next month. So nobody knows what's going to happen in 5 years. But what I want you to take away from this slide is that even the pessimists are thinking that home prices are going to continue to appreciate over the next 5 years. There's nothing on the horizon that we can see currently that has the potential to really crash the market. Now, speaking of which, what can we expect for the greater Milwaukee area? First of all, the number of new listings is going to increase. We are having a few listings that we're bringing on the market next month. So not that that's going to change the market single-handedly, but there's a lot in the works across the board. So we are going to see more inventory every week as we're going forward. And buying is going to get easier in the next few weeks. You will see every week a little bit more inventory show up on the MLS. Interest rates are rising faster than expected. I think this is going to be a major impact factor, and not necessarily in the way that it's slowing down the market, but maybe later on it will do that. But in the immediate future, it just adds more urgency because people want to move on with their plans and lock it in, no matter if they're buying their first home or if they're actually selling a home and want to, buy a bigger home and lock in the 30-year fixed rate mortgage on the low rate for the new bigger home. So with that being said, if you have plans for 2022, you have my contact information here. Here's my team. We are ready to help you with your real estate plans for 2022. And if you're thinking about selling your home this year and you're not sure about the strategy, what the right timing is, depending on your personal situation, I would love to sit down with you and have that conversation. I just finished my new guide. It's 35 pages about everything that I have learned in the last 10 years about how to sell a house in the Milwaukee market, take advantage of the opportunities that this market is offering. It's not a new miracle method that is radically different from what everybody else is doing. It's just a collection of best practices and executing everything on a really high level. So reach out to me, send me an email, send me a text message. You have my contact information here right on the screen. I'm looking forward to hearing from you. Thank you very much for watching, and I'll see you at the next one.